This morning we're going to start by looking a little closer to home at the Australian economy. The good news is that we've just moved into the 27th year of expansion, but of course this week's economic growth numbers look backwards and not forward. So what is the future? As one headline said this morning, household incomes dismal, wages flat, and spending props up the economy. What could possibly go wrong? And of course, energy prices add to the lack of cash to spend. A nice background for you, Sally.
Thanks very much, Ali, and good morning, everyone. I'm delighted to be here and be part of your conference today and to have the opportunity to talk to you about some of the sort of big themes that we think are relevant for the Australian economy and what they might mean for markets over the next couple of years. So up on the screen, you can see the agenda for the first 30 minutes of today. Talk a little bit about what we're seeing in the economy. Then we want to talk about maybe some medium-term themes for bond markets, for currency markets, also for equity markets, and then finish up with some conclusions. So let's get stuck in. Ali's already given us this week's news. GDP was up 0.8% in the second quarter. It was a touch below what the market had expected, but basically bang on line with where the RBA had forecast growth for the quarter. So that was a pretty good result, and as we also heard this morning, starts off our 27th consecutive year of expansion. So the chart up on the screen is basically quarterly GDP growth going all the way back to the early 90s. And there are a couple of remarkable things about this chart. The first one is you can see those two little negative quarters back in early 1991. That was the last time we had a recession in Australia. So that was when Jeremy Irons won the Oscar for Best Actor. Monica Seles won the Australian Open. It feels like a long time ago, and that's because it was. And I was sort of interested to think about what proportion of Australians out there actually remember the last time we had a recession. So if you think about it, pretty much anyone who is 44 or younger was not an adult back in 1991. And that actually makes up 60% of our population today. So we have more than half of the Australian population who wouldn't actually probably remember what a recession looks like, which I think is quite interesting. Anyway, since the recession, we've had 4 quarters of negative growth. You can see in 2001 around the tech unwind, obviously in the financial crisis, and then we had a funny little one-off last year and also a little bit earlier in the decade. But basically what that's meant is growth in Australia, if we look at it in annual terms, has never dipped below 1%. And that's a remarkable record, especially when we compare ourselves to our peers in the G20 or elsewhere. What I want to do now is to sort of think about how we got there. And this second chart basically shows you leverage in the economy, and we're comparing leverage in the household sector, which is the grey line, to leverage in the government sector, which is the black line. So the grey line is basically household debt as a percentage of income, and the black line is sovereign bonds on issue as a percent of GDP. And I guess the thing that's very striking about that chart is how, the black line has basically been pretty well behaved. It's gone up over the last 5 or 10 years, but it still looks pretty low. The one that's gone up pretty much in a straight line over the last couple of decades is household leverage. And so this is sort of the dark side of our very amazing growth track record, which is that a lot of the growth that we've generated, I think, has probably come at the expense of future growth. I mean, the whole idea about borrowing to consume today is that you're not going to do it tomorrow. And that's effectively what that chart tells us. It's interesting, I think, that the RBA has basically called time on this story. So, we heard earlier in the year the RBA Governor, Philip Lowe, pretty much say we're quite worried about that grey line. Household debt to income is almost approaching 200%. And the RBA's view, I think, is very much that this is going to exacerbate Australia's vulnerability to any sort of shock when it comes. And it will come at some point. So that's why we've seen the RBA perhaps a little less reluctant to take rates lower and to endure a period of growth which is probably not as strong as they would like it, with a labour market that's not as strong as they would like it, and also with inflation that's not as high as they would like it, because they're worried about adding to what I think is one of our key medium-term vulnerabilities in Australia. The second thing about this chart that I think is quite interesting is that if you compare those leverage ratios to, say, a G10 average, what you find is that our household sector is about 1.5 times leveraged relative to the average, and our government sector is about half. So we have a very, asymmetric distribution of debt in the economy. Too much on private sector balance sheets, probably not enough on public sector balance sheets. And I think the question that this chart raises is effectively, at some point down the track, if we need to borrow more to perhaps give the economy a short-term boost, it's not really going to be the consumer who's doing it. It'll probably have to be the government who does it. And that brings associated questions with it, like, are we willing to do it? Because if we do it, we'll probably lose the AAA sovereign rating. Some people might argue that's just not a big deal anymore, in the sense that AA is a new AAA anyway, so who cares if you lose it? But, for an economy that's still very reliant on offshore capital to fund this debt, perhaps we shouldn't be so blasé about it. So, next chart, which is, I think, another interesting one. It sort of speaks for itself. What it shows us is dwellings under construction per 1,000 residents. And so what we've taken here is the average of New South Wales, Victoria and Queensland, just simply because we know in the big capital cities on the eastern side of the country, this is where a lot of the construction activity is happening. And so the message, I think, here is that we are building a lot of dwellings. A lot of them are medium density or high density apartments, particularly in the cities. But the point is, you can see that chart's had ups and downs over the last couple of decades, and typically the ups are driven by interest rate cycles. So as the RBA has cut rates repeatedly over the last couple of decades, it's generated multiple housing cycles. The last one looks pretty spectacular by any sort of measure. But I think it's sort of telling us that we've played this card multiple times over the last 10 to 15 years, and so the game's probably up. We don't really need any more dwellings, certainly in the residential sector. So the first two charts are just sort of trying to get across the message that we've relied a lot on consumers leveraging up, we've relied a lot on juicing up construction cycles, house price cycles. We've done that repeatedly over the last couple of decades, and I think for good reason, we should probably expect that neither of those two sectors, residential construction or consumption, are really going to be a powerful source of growth for the economy over the next sort of 5 to 10 years. And that's going to be a very different sort of feel to the economy. If you go back and just average it out, basically quarterly GDP has averaged 0.7 over the last couple of decades. Together, residential investment, construction and household spending have usually contributed 0.5 of that 0.7. So they've been, over the long run, a very significant, powerful driver of growth. And my sense is that that's not going to be the case over the next little while. All right, one final chart. It wouldn't be right to talk about Australia's growth story without mentioning China. And I think this chart is interesting because it gives us a long-run perspective on what's going on with Chinese growth. So what it shows us is the grey line is just GDP growth, so it goes sort of up and down. The black line is the interesting one, and it projects out to 2035, and what it shows is the change in the Chinese labour force. So one of the really interesting things about the world, and I think particularly China at the moment, is what's going on with demographics. And we always talk about, say, Japan or Europe or even the US and the challenges they face with an ageing population. The story is far more acute in China than it is really anywhere else in the world. And what this chart basically shows you is that changes in the labour force are, over time, a very powerful anchor for GDP growth. So you can go up or you can go above or below that long-run trend line, and they're the sort of cyclical ups and downs that an economy has over the course of a business cycle. But over the medium to longer term, basically it's labour force supply that really anchors, the long-term growth story. And so this chart here tells you a pretty powerful story, which is that because the labour force in China is starting to shrink, long-run or potential growth, as economists like to call it, is gradually going to slip over the next couple of decades. And that sort of leaves the authorities in China, I think, with a pretty interesting situation in the sense that they're going to need to manage China's transition to lower rates of growth. So, we had a sort of golden patch in the mid-2000s where Chinese growth was double digits. We're not going to have that anymore. So, over the next couple of decades, Chinese growth is going to transition from sort of 10 to 7, which is sort of where we are at the moment, down to the 6s. And you can see on this chart, we're going to get potentially sort of closer to 5, 4. And at the same time, China has another problem it needs to deal with, which is the amount of leverage in the system. So we've talked a little bit about the leverage in Australia. leverage in China is even more, I guess, intense. It's held primarily in the corporate sector in China. And so these are the two big tasks that China has to deal with, amongst other things, over the next sort of 5 to 10 years, is how to deleverage the economy, but also how to transition the economy to slower rates of growth on average. And I think for Australia, what that probably tells us is that it leaves us and the Chinese authorities with a rather asymmetric risk profile to growth. So in the sense that the best we can hope for is that the Chinese authorities manage to do this in a way that's not too disruptive to their own economy or to the global economy. But that will mean, over time, slower rates of growth. The worst case scenario, and this is why people are a little bit worried about China, including the RBA over the medium term, is that there aren't really any success stories about deleveraging an economy without creating disruptive events either to the financial system or to the real economy. So it does leave us with a very sort of asymmetric growth profile for China. The best we can hope for is slower growth. The worst case scenario is something far more disruptive. So what does all this mean, I guess, for investment trends if we think about markets? Well, there are 4 themes that I sort of want to talk about today. The first one is that rates probably aren't going to go a whole lot higher in Australia. However, Australian interest rates are still going to look very attractive relative to our G4 peers. The third theme is around the currency. It's hard to see the currency going a whole lot lower, I think, without getting really bearish on China or getting really bearish on the domestic economy. And then I think the fourth theme when we think about equities is just simply that the ASX faces some pretty challenging headwinds. If we decompose our stock market sort of sector by sector, it's really hard to find sectors where you are medium-term positive. So these are all sort of broad themes for markets. And if we start with the first one, I mean, this is a chart of the RBA cash rate going back to the late 90s. And you can see we have had periods where the RBA has lifted rates, but the most powerful sort of direction or force on interest rates over the last couple of decades has been down. And there are lots of reasons for that. One is that central banks, have been successful in basically containing inflation. Obviously, the financial crisis and some of the associated effects of that have meant that the whole term structure of rates globally has shifted a whole lot lower, and Australia's been dragged along with that. But my sense is that the amount of household leverage that we have in this system, most of that lying in the housing market, is probably going to cap the extent to which rates can rise over the next little while. So my best guess, and it really is a guess, that probably over the next 3, 5, 10 years, I think the RBA cash rate will probably be somewhere between 0.5%, so another percent lower from where we are today, and then on the upside maybe 2.5%, 3% if we're really lucky. But I think we have to accept that we are in a much structurally lower setting for interest rates overall, and my sense is that if we get to the point where the RBA feels confident that the economy is doing well enough it can execute some rate hikes, I think they're going to be reasonably cautious about the way they do it, and I think the extent of leverage will probably limit the nature or the size of any tightening cycle to probably 100 basis points at most. Second theme, I think, is an interesting one. I mean, we like to talk about some of the cyclical challenges that the economy faces over the short term, particularly around housing and the consumer, but there are actually reasons to be medium term relatively upbeat about Australia, and I think 2 of those relate to the productivity story in Australia and also population dynamics. So the chart up on the screen basically shows you output per hour work, so it's like a measure of productivity, and what we're looking at is what's been the cumulative deviation of that series from its pre-financial crisis trend. So pretty much the story is not a great one for some of the big economies out there. So in the US, Japan, the UK, and G7 more broadly, basically the trend has been lower. So particularly in places like the US, Europe, and the UK, productivity growth has been abysmal. I'm not sure that economists really understand all the drivers behind that, but it's sustained for quite a while now, and it's making people worry that this is now a structural story. Demographics is playing a role, technology might be playing a role, quality of education might be playing a role. But the good news for Australia is that the story is much better for us. So Treasury just last week released a paper basically which goes into sort of calculating labour productivity, and the main message from that paper is that labour productivity has actually improved in Australia over the last 5 to 10 years, and that's really against the trend that we've seen in other developed economies. So over the medium term, when we think about what is it that anchors GDP growth, it's all those things that Peter Costello used to talk about when he was Treasurer, the 3 Ps. It's population growth, participation and productivity. So on productivity, we're doing relatively well. Similar sort of story on population growth. We've talked about the role of demographics. Relatively speaking, Australia's population growth looks very, very solid compared to other G7 countries. It's partly a function of a fertility rate that's a little bit higher than average, but it's also a function of strong immigration as well. And the one country that's doing way better than anyone else in the world on population growth is actually New Zealand, where population growth there is running above 2% per annum, which is quite remarkable. So the third part of all of this is the participation rate. So it's great to have the productivity, it's great to have the population growth, but the missing part in all of this is participation. So having the population and getting that population to participate in the labour market. And there, if we had the chart on here, we'd see a similar sort of picture. Australia does relatively well in that. So our participation rates, both for men and women, are actually quite high relative to a G7 average as well. So I think what this story tells you is that while we face some cyclical challenges, over the medium term in a relative sense, the fundamentals for growth still look pretty good in Australia. And so this all comes down to helping us estimate where trend or potential growth is in economies. And you can see on that table, we are a real outlier compared to some of the big developed economies. So potential growth in the US, our economists put at 1.5%, and that's on a good day. Sometimes they worry it could even be a little bit lower. Now, that's quite remarkable because if you go back to, say, the early 2000s, around the time of the tech boom, our economists would have pegged potential growth in the US at 3%. So it's halved over the course of 15, 20 years. Europe, 1%. The UK looks a little bit better at 2%. And then poor old Japan sort of struggles, with trend growth at sort of 0.5%. In Australia, we market it at basically 2 3/4. So when economists sit down and try and work out, where potential growth is in any economy, it's effectively just a combination of labour supply growth and productivity growth. So on both those measures, we're benching well above our peers, and I think that'll help us over the medium to longer term from an interest rate perspective, because this chart is effectively what anchors interest rates over the long term. So I think there's a case for Australian interest rates remaining on average above those of the G4, and that's partly, or in large part, because of our very solid population productivity and participation rate fundamentals. So that's the good story, I think, for Australia. The currency is an interesting one, and not unrelated to interest rate differentials, but this chart shows you the real effective exchange rate. So it shows us the exchange rate in Australia against a basket of currencies, but also adjusted for inflation as well, and it's a 20-year chart. But basically, where we are right now is sort of 10% above our long-run average. So, we're still trading rich or expensive relative to the long run, but my sense is we're probably going to stay there, I think, unless we have a nasty shock that emanates from China or a nasty shock that emanates domestically, maybe because the housing market finally sort of starts to melt under the weight of macroprudential regulations, too much debt, etc., too much supply. But without either of those things, and neither of those things are in our forecast, I actually think the currency is going to perform reasonably well. And I think part of that sort of long-run real interest rate differential, which is generated by having potential growth above most of the Western world, is a big reason for that. So it's a difficult one, the currency, because I think for Australia, what we really need is a little less asymmetry in our overall financial conditions. In a perfect world, if we could choose both, which we can't, but if we could choose both, we'd probably all agree that it would be better to have rates a little bit higher, and it would be better to have the currency quite a bit lower, but unfortunately that's not where we are. We're sort of stuck with rates being very low, currency really being quite elevated. And that's why, you have seen the RBA, they've been reasonably gentle about it, but just in the last couple of months as the currency has crept up towards 80 cents versus the US dollar, start to express a little bit of concern that if it stays here and if it goes further, then that's not going to be great for output growth, it's not going to be great for the labour market, it's not going to be good for the inflation trajectory, and so it'll just cement this idea that low rates are here probably for longer than the RBA would otherwise like. So my own view is sort of over the medium term, I think the currency is going to be reasonably well supported if we can avoid either of those nasty shocks. So finally, on to equity markets. I think this chart's pretty striking. It shows the ASX 200 against the MSCI DM index, so basically comparing us to our developed market peers since 2013. And what the chart shows very clearly is that we've underperformed quite significantly over the last couple of years. So if you'd sort of put all your money into developed market equities offshore, you'd be up sort of 50%. In Australia, you're up sort of, I think it's 20%, 25%. So it's been quite a significant underperformance. And I think part of that is explained by the fact that the Australian business cycle is out of sync with what's going on globally. So that's basically been the case, I think, since the early 2000s, where, before, if you can remember your economic history and think back to the 80s and 90s, when the US had a horrible recession in the 80s, so did we. When the US had a horrible recession in the 90s, so did we. But basically what happened after that is our business cycles started to decorrelate. And I think a lot of that happened around the tech cycle. Australia didn't have any exposure to tech. Global capital used to punish us for that. They used to say, well, you guys are just old economy, all you have is agriculture, you just dig stuff out of the ground, you've got no exposure to tech, who wants to invest in that sort of world? Not me. And so you can almost draw a chart of the NASDAQ, which was like that, and mining investment in Australia, which was virtually the mirror image. And so that's effectively when our business cycles started to move apart, because when the tech bubble burst, we were relatively well insulated from that. So as the US was dealing with that through the early 2000s, for Australia along came the housing boom in the early 2000s, and also Chinese demand started to grow very, very strongly. And then ever since then, and the GFC sort of exacerbated it because we never really had the recession here like a lot of other countries did, our business cycles have been out of sync. And I think this partly explains what's going on. So for a lot of developed economies, it wasn't a great time after the financial crisis, but with all the sort of accommodative monetary policy that's been put in place, finally, US growth is growing above trend. So US is growing a bit over 2 at the moment. Trend is 1.5. Similarly, Europe's growing at 2. Trend is 1. Even Japan's growing better than trend. So a lot of these big economies are finally starting to come back to life. But for Australia, it's been a bit of a struggle to get to trend or even better. And I think that explains part of the reason for our underperformance. The second reason is I think also recently, if we think about the ASX in terms of sectors, it's sort of really hard to pinpoint one that you feel really optimistic about. If we look at the consumer, our analysts at JP Morgan are quite worried about the impact of Amazon on bricks and mortar retailing in Australia, so they're pretty underweight a lot of the consumer stocks. If we look at financials, if we think that the business model that's worked so well for banks over the last decade, which has relied on the household sector leveraging up, the housing market doing better, that story is sort of over. So it's going to be more difficult for banks to generate, I think, the sort of profits that they have over the last couple of decades. So, maybe you're a little bit cautious on financials. I think it's probably resources are the ones that stand out. The resource companies have been phenomenal about being disciplined on cost. China, if it can sort of manage those 2 big structural issues it needs to manage over the next little while, will mean that the resource sector, I think, does pretty well. But you're always going to have that sort of cloud hanging over you that you're always at risk if you're overweight resources that something goes wrong in China. But anyway, I think you sort of get the point, which is that, given the concentrated nature of our stock market, it's sort of hard to really find a big chunk of the market that you want to be overweight. So let's just finish up with some conclusions. On the economy, medium to longer term fundamentals look okay. So population growth, productivity, all those sorts of things. We've got some cyclical challenges, largely related to the consumer and housing. And I think if we can manage these, and the RBA is sort of doing their best for us on that front at the moment, I think we're going to muddle through. And my sense is a muddle through economy is probably one where we grow with growth with a 2 in front of it. So I just don't think, contrary to what the RBA thinks, that in a couple of years we're going to be growing well above 3. I think the best we can hope for, given some of the constraints that we've got, is that we have growth with a 2 in front of it. And that doesn't feel great for Australians, but it looks really good in a relative context. So that would be my sort of view on the economy over the next little while. If we muddle through, I think the sort of three key themes for markets are you want to buy duration on dip. So like I said, rates aren't going up a lot here. So when you get these little sell-offs, whether they're spurred by events offshore or otherwise, you want to keep owning some exposure to interest rate duration. Aussie dollar, I think you probably want to buy it on dips. I can't see the Aussie dollar really trading significantly below the low 70s as much as we probably need it. And I think in equity markets, for the time being, you probably want to favour overweighting other markets rather than the domestic market, while we sort of deal with some of these cyclical challenges in the near term. What are the risks to this view? Well, I think there are upside and downside risks. On the downside, clearly China is a big one. We talked a bit about the asymmetric risk profile around growth in China. A sharp correction in housing. Some people sort of are saying this is well overdue in Australia. It's time to effectively face up to the music, and you can't just have sort of a period where house prices grow so strongly for so many years, household leverage increases at such a rapid rate for so long without paying the price for that. But on the upside, I think two things that would make me really bullish on Australia would be if the Aussie dollar, for whatever reason, fell into the 60s and stayed there for a while. I think if we could engineer that, and that's a really big if, that would be very positive for the economy on a number of fronts. It would tick a lot of boxes for us. It would really help finish that growth transition away from mining into something else. It would give us some inflation, which is what the RBA wants. They don't want a lot of it. They just want a little bit more to sort of feel confident that we're back to target, and a lower currency would certainly help with that. And the other big thing that I think could be interesting is if we start to see meaningful lift in private capex spend. It's been really one of the puzzles that's confused economists, for the last sort of 5 or 6 years is why has capex spending in the private sector, particularly non-mining capex, been so weak? Well, I think in the last couple of weeks we've started just to see some very early signs of good news on capex. So one of the interesting themes around reporting season in August was that there were a number of companies, not a huge amount, but a number, who basically said the time for obsessing about capital management and balance sheet management is over. We're cutting dividends, and instead we're thinking about lifting capex spend. And that's the first time we've seen that sort of thematic in a reporting season in a long, long time. So that's good. The second thing that happened just in the last couple of weeks is that we get quarterly updates on capex spending from the Bureau of Statistics, and they give us what happened in the quarter, but they also have a survey of firms about what they're going to spend in the year ahead. And for the first time, you get the sense that firms are starting to lift their expectations around how much capex they're going to spend over the next sort of 12 to 18 months. Now, what I would say is that this is already in the forecast. So whether you look at the RBA's growth forecast or our forecast at JP Morgan or the consensus growth forecasts, they're all predicated on that private capex starting to lift. So the good news is that what it will make forecasters feel is a little bit more confident that their forecast for economic growth this year, and the street's around sort of low 2s for Australia, is the right forecast. And I think, if we really started to see a genuine lift in capex spend, then that would actually be, a really positive sign for the economy as well. So I think my 30 minutes is almost up, so I'll leave it there and look forward to answering your questions in the next little while. Thank you.
Thank you, Sally. Please do remember to put your questions through via the app, should you wish, or we'll also have some microphones roaming the floor. I just wanted to ask you, first of all, going back to near the beginning of your presentation, when you talked about how, of course, borrowing to consume today means that we won't be doing it tomorrow. I don't know, I keep going. But it obviously means that it could exacerbate our vulnerability to any shock when it comes, and it will come. I just wanted to ask you to sort of place some bets on where is the greatest likelihood of a shock. You've talked about housing market domestically, you've talked about risks in China. What do you reckon is going to come?
Well, I think one interesting thing about the US at the moment is that the US expansion is the third longest on record. So we know that expansions don't last forever. And I think one thing that people are starting to grapple with at the moment is how could that expansion end? Is that because we eventually get the return of inflation and the Fed says, oh goodness, we're behind the curve and we've got to hike aggressively and that's what kills the expansion? Or Could it just simply be, there's a school of thought out there that the unemployment rate just can't fall any further, so at some point it's going to start to go back up, and is that what kills the expansion? So our economists in JP Morgan in New York, run these models about, they try and estimate the probability of a recession over any given period. So over the next 12 months, the models say 15%, which is nothing. But over the next 2 or 3 years, they're starting to say 60% in the next 2 years, 75% in the next 3 years. So I think the sense is that at some point in the next 3 years, probably the US cycle will end, and I think that's going to be a meaningful development for the global economy and for us as well. The worst sort of scenario would be the US cycle ending and something going wrong in China, because then you've got the world's two biggest economies in trouble. So I'd watch the US cycle pretty carefully, and then I think China's just the elephant in the room, right? I mean, you haven't been paid to be bearish on China at any point really in the last couple of years, but you do feel like the juggling act is getting more difficult for the authorities over there. So
we're going to look at China in a session this afternoon, but you make the point that there are no success stories of deleveraging economies without creating some form of disruptive event. So is it your best bet that one way or the other there is going to be a level of disruption? The question is, it can't be smooth sailing. The question is how big a disruption?
Yeah, I think that's the right way to think about it. I think there probably will be some sort of disruption in China, but they do have a significant government balance sheet, so I think they'll throw a lot of money at the problem, and that'll mean that it's probably not as bad as it could possibly be. But I think it's probably fair over the next 5 years to think that there will be patches where we really do start to worry that something's going quite wrong in China, and then it's really going to be a question of what resources will the authorities throw at it to contain it.
And the first question that came in on the app was actually one that I had, and one that we talked about a little yesterday, the issue of wages growth and how persistently low it is. It's not a purely Australian problem at all. And you mentioned how we're actually doing pretty well on productivity. So what is holding wages growth back, and what will be the impetus for that to change?
So the fact that we're doing better on productivity is a good sign, because I think when people look at the offshore situation and they see low wages growth, they say, well, a lot of that can be explained by low productivity growth in some of these big economies. So the fact that we're doing a little bit better on that front is a good thing. What's different here relative to other economies? We talked about the fact that Europe, Japan, the US are all growing above trend. Unemployment rates are falling, so labour markets are tightening, yet wages growth is still very elusive. So that would be the one thing I think that might worry the RBA a little bit. We're not at that point yet, so we're still at a point where we're not growing at potential, where the unemployment rate is still above what economists call NAIRU, which is once you get below NAIRU, then you should start to generate some inflation pressure. So I think the thing that might worry the RBA is that the offshore experience is telling us even if you can grow the economy strongly enough that you can tighten the labour market, increase demand for labour, even that's no guarantee that you're going to get wages growth. So Phil Lowe is sort of telling us that, look, nothing's going to change in the short term, but he says we still believe in the fundamentals of supply and demand, that if demand for something goes up, then the price should go up as well. So his expectation is that, if we can get the economy growing strongly enough that we can create some excess demand for labour, wages should start to lift. And I think he's a little bit heartened. He said, out there are pockets of labour shortages, like IT security I think is one that they've mentioned, and wages are going up in that sector. But I think from a broader perspective, one of the reasons in Australia wages growth has been so subdued is not only has the labour market had excess capacity in it, but Australia has been uncompetitive globally, and getting the currency back down to the 70s has helped with that, but it's not low enough, and that's why a lot of the adjustment is happening internally, which is running real wages at zero. So until we reach that point where we finally say, we're now competitive enough, global capital wants to invest here, it's hard to see how wages are going up anytime soon. And that's a real issue when household debt is so high, because how do you get rid of the debt without meaningful incomes growth?
Another question here that referring, you weren't here yesterday when Dr. Stephen Kinsella, he was talking about levels of debt, and the question is, has any household or housing debt bubble like ours ever deflated slowly? Kinsella was talking about unwinding the ECB's monetary stimulus policies, and he was saying things don't unwind slowly, you burst the bubble and the bubble pops. Has it ever been done? Have you ever managed to get a debt bubble like ours to wind down slowly?
I think the short answer is probably no. Normally these things end because rates go up. And this is why it's so hard for policymakers at the moment, because you've got one part of the economy that feels very late cycle, which is, credit growth has been strong, house prices are going up, leverage is going up. So that all feels very late cycle. And then you have another part of the economy, which is inflation, that feels really early cycle, which is inflation is low. Normally what you would have in a normal sort of cycle, you'd have high inflation and high asset prices. And so for the central bank, it's obvious, you just got to hike rates, and that's how the whole thing ultimately ends. At the moment, in Australia and in New Zealand, the central bank can't do that because they don't have inflation at target or even above target. So they're walking a very sort of fine line between trying to really nurture what is a very nascent recovery in inflation, but also dealing with an asset market that looks overcooked, and they're trying to do that through macroprudential. And so what you're trying to do is you're trying to cool the asset price market, but you don't want to crush it, because if you crush it, then you're going to completely destroy any of the good work you've just managed to do on inflation, which is not great when your mandate is to be an inflation targeting central bank. So I think New Zealand is a little bit more advanced in this story than we are, where inflation is still low and the housing market is now slowing quite quickly. So my sense is that the central bank, even though they haven't really publicly expressed this sentiment, is going to start to worry a little bit that things are slowing too quickly in housing, and that's going to threaten the domestic growth story and the inflation story. So it's a really unusual situation that central banks find themselves in, and it's why the RBA is sort of stuck, in the sense that they can't hike rates because inflation is too low, can't cut rates because the housing market and household leverage are sort of too high, and they're stuck. So we'll see. If we can get through this one, I think it'll be quite remarkable. But
How do you rate their chances?
Well, at the moment we're going okay, so I think if we can make progress on this before whatever shock comes down the track, then we might get through. But if the next shock was to turn up tomorrow, then I think right now we look pretty vulnerable.
And I wonder how much all of that is also linked into the political sphere here. There is a question here about the extent to which CapEx and that sort of thing is being constrained by inertia. I've just lost the question. Here we are. How linked do you see CapEx spend with political inertia in Australia?
Yeah, so I think that's definitely a theme that the RBA has picked up on when they do quite an extensive liaison program with corporate Australia, large and small. And one of the messages that they do get back from corporate Australia is just frustration with the political environment and the lack of reform and the lack of sort of anything sort of really positive happening on the economic front as a reason for not investing. I guess my sense is that's probably not going to change anytime soon. So I think that's part of the story. And clearly, big things like energy policy matter as well. So uncertainty around energy policy, I think, will increasingly become an issue for particular firms who are big consumers of energy. But yeah, I think we all would agree that things could be better if perhaps the politics was more constructive.
It's interesting that you, when you talk about sectors in Australia, and consumer and financial and housing will struggle, resources/materials will do okay, but generally in equities you said you'd actually put your money overseas as opposed to putting it here. Where would you put it?
Well, I think as a house, we're pretty upbeat on European equities still, so we still see a lot of upside there. So Europe's been the success story really of the last couple of years. Really strong growth, very positive cyclical recovery. The banks are doing a whole lot better. So we like Europe. US equities, excuse me, we still have upside there. And even EM equities, I think we're pretty constructive on there. For the first time in a long time, there's no one part of the EM universe that's in recession or really struggling. So, I think given the global growth backdrop, which is the best it's been in probably 6 or 7 years, offshore equities still look pretty attractive to us.
I've got lots more questions, but do we have a question from the floor? Yes, we do, just down there.
Hi, can you see India playing a role as China did about 15, 20 years ago, going forward?
Yeah, I think one thing that really stands in India's favour is its demographics. So, we saw that chart on China which shows that, there's not a lot they can really do unless they want to run a big immigration program about what will happen to their potential growth over the next couple of decades. India is in a very different situation. So I think, generally, can they be as big a player as China? Maybe. They certainly have, the right sort of Prime Minister in charge, who is pro-reform. I think most people would agree he's found it a little bit harder going in the job. So, like a lot of politicians over the last decade, very high expectations, but the ability to actually execute a lot of reform is more difficult. So I wouldn't necessarily see China, I guess, as making as big an impact as China has in the last couple of decades, but I definitely think they are almost a bit of a sleeper in the sense that they're going to grow slowly, and I think probably in 10 or 15 years' time we'll sort of look up and say, wow, look at India, they've sort of moved themselves up the ranking. If they can get on with the economic reform process, I think they've definitely got the fundamentals to be a reasonably significant player in the EM world.
There's another question here. This actually relates to China, not India, but it does ask the question about One Belt, One Road and the extent to which that will have an impact. Its success or failure will have an impact here.
Yeah, well, it's One Belt, One Road is basically about building huge amounts of infrastructure. So, if they're successful in executing that, then that sort of tells you a pretty positive story about China's demand for resources over the medium term. So I think that will be, pretty significant for us. I have heard people worry about that whole initiative and sort of say, they feel like China is carving out, a whole sort of chunk of the world to itself. So these are people sort of from supranational organisations like the OECD and, who seem to be a little bit worried about the long-term consequences of what China is doing.
Well, the Australian government as well, which has not signed up to One Belt, One Road.
Yeah, that's right, yeah. So, from a purely economic perspective, I think it'll be a good thing for us if it's successful over there, but from a geopolitical perspective, maybe there are some slightly more worrying questions.
Another question here is that you talked about a growth transition from mining, but from mining to what? What is going to be the next big thing?
Well, it won't be the consumer and it won't be housing. It's a good question. That is the question that a lot of offshore investors ask. They say, where will the growth come from? Like, if you guys aren't upbeat on the consumer and you think that the housing story is done, where does growth come from? So at the moment, if you look at the GDP numbers we got on Wednesday, net exports are a decent contributor. That story will continue with LNG and coal and iron ore. Infrastructure spending is doing its bit, so that's going to help us for the next couple of years. As we know, in New South Wales and Victoria, there are some really big infrastructure projects happening, so they will add to growth. But
they're not going to be a long-term saviour.
They're not a long-term thing. They're funded by asset sales, and most state governments have sold most of their assets, so there will be a limit on that. So that'll help for the next little while. But beyond that, I think that's the right question to ask, and it's not obvious to me what the answer necessarily is. And that's why I think part of the story of sort of wanting to be optimistic on Australia, I think, increasingly a necessary condition for that to be the right way to think about our country and our economy is we need the currency a lot lower. I think that would make a huge difference to growth prospects.
We have a question here.
You pointed out that you see Australia's GDP higher than some of the major economies around the world, but against that you prefer overseas equities versus Australian. Just sort of tie up those two conflicting views.
Yeah, so I think the way I would answer that is to say, that's a sort of more a short-term or tactical view in the sense that I think we've got some cyclical challenges. So, you can have a trend growth rate. You'll spend periods above the trend and you'll spend periods below the trend. And one way to think about the equities story is that, for a lot of those countries, Japan, Europe, US, they're all travelling above potential growth at the moment. Australia's travelling, we're below potential. So I think from a sort of tactical perspective, that tells you, where your relative weights want to be in thinking about global equities. Over the medium term, I think, economic theory tells you that if you think about the factors of production, capital and labour, people sort of generally think as capital is fixed in the short term, labour is the variable one. And if you increase the variable one, theory tells you should increase returns on the fixed factor of production. So if you have high population growth over time, returns to capital should be higher than they otherwise would be. This is where New Zealand's really interesting, because if you actually look at, and not that the New Zealand equity market is a huge market by any means, but it has been, I think, the best performing equity market in the last couple of years. And I don't think that's just a random outcome. I think in part that's been driven by the fact that they've had such solid population growth. So I guess what I'm saying to you is I'd be happy to be underweight Aussie equities, overweight offshore equities for the next little while. But then if I thought that the growth cycle in Europe was starting to roll over, similar story in the US, I'd think about switching that for a more medium-term strategic allocation.
Your question?
Thank you. Just quickly, throughout your talk, you mentioned things that definitely touched on the demographic shifts that we're experiencing around immigration, growth, etc. One of the sectors that I was curious to hear your thoughts on, I think I saw a chart a few months ago that the third largest component to our GDP is the education sector. What are your thoughts around growth of education, particularly around the global demographic shifts that are taking place today, as well as what is happening with in our sector with the demographics of the baby boomers retiring?
Yeah, so education services is one of our key. I mean, we focus on the commodities, but when it comes to services, tourism and education are the two big ones. They're also very currency sensitive. So I would be happy to be really bullish on the education sector. If you told me a story that the Aussie dollar would be under 70 cents for the next couple of years, I think that would be phenomenally powerful for that sector. But I think, the education sector's done very well at sort of courting the offshore student, and I don't think that's going to change anytime soon. So I think, over time the fundamentals are pretty solid there, and we are effectively a services economy, so all these sort of services sectors are going to, over time, contribute probably more to growth than they have over the last couple of decades.
So another quarter of a century of uninterrupted growth for
Let's
Australia?
hope so.
Please join me in thanking Sally Auld very much for her insights.